What you're about to see is a clip from my Wall Street Unplugged Premium podcast, the insiders who see the markets before the rest of the world catches up. Check this out.
We all want to make money as quickly as possible. We want to make a ton of money and we want to make it right away. And we do more trading in this portfolio versus investing. And the biggest difference there is your timeline. The hyperscalers, tech, AI, power, all that is getting a lot of limelight, as it should. But one of my favorite industries, and I'm just going to talk about this briefly here, is the insurance, property and casualty. And so here's Chubb Limited, CB, and they just came out with solid earnings, and it's off its 52-week high. And here is W.R. Berkley, slightly off its high as well. But you can see these two stocks are some of the best property and casualty insurance companies. And remember, the key thing here when you look at property and casualty insurance companies is the combined ratio. And you want it to, the lower, the better. So if you have a combined ratio of 100, that means that you are taking in the same amount in premiums that you are paying out in claims. All right. That is no bueno. You want to be making money. If you have a combined ratio of over 100, that means that you are taking in less premiums than you are paying out in claims, and you are operating at a loss. No bueno. Now, if you do that, and it can happen for periods of time, but you're starting out on the hole there, then you need your investments. Remember, you're taking premiums in right away, and you're paying out claims over time or in the future. In the meantime, you take those premiums and you invest them, typically in bonds or whatever type securities. So the combined ratio is key. W.R. Berkley, for its Q2, reported a 91.6 combined ratio. It would have been a little lower, a few percentage points lower, but they had some catastrophic losses. For Chubb, let's switch over here. So this is W.R. Berkley. For Chubb, and they have much more international exposure. Chubb reported 85.6 combined ratio. And again, it would have been even lower if you take out the catastrophic events. But one thing I respect, I love both these companies. I love listening to both the CEOs because they seem just transparent and straightforward. And one of the things about the Chubb CEO is you have to include the catastrophic number because you're always going to have those. You kind of itemize them out. But if you don't think that moving ahead, you're going to have hurricanes, earthquakes, fires, natural disasters. I just don't think that's a smart idea. But it can be a red flag if you have such huge gaps in between your combined ratio, including catastrophic losses and such. And the reason I point this out is because these guys, both Chubb and W.R. Berkley, are slightly off their 52-week highs or all-time highs. But these are fantastic businesses, and they are going to reap the benefits of higher interest rates. They don't need interest rates to go up from here. They just need them not to fall out of bed in a very fast pace. And the reason I say that is because up until 2022, when the Fed started raising interest rates, companies like this, doesn't matter how well you are managed and run, you got nothing return on your collecting of premiums because you had nothing to invest those in the form of bonds not paying much interest. Now, Chubb and W.R. Berkley are collecting those premiums and they're investing those in bonds and other securities today at between 4 and 5%. In Chubb's case, just because they're a larger company, Chubb's between 105 and 110 billion. W.R. Berkley, I think, is 25-ish billion. That's millions of dollars per quarter for W.R. Berkley, and that's $1 billion in net investable income for Chubb. The reason I'm telling you this is because I know these are out of fashion, these aren't sexy, these aren't exciting, but these are more of your buy and hold type of investments where you can buy them, and if you get some timing right or some luck or whatever, you can get a good boost right away. We're only up 50-ish% in CRA, and we've held this for a couple of years in Chubb. I put this in there after the coronavirus outbreak and such, but I feel like people are compounding their money in a lower risk environment. And when I look at Chubb Limited and W.R. Berkley, those are the type of businesses that are going to continue. Everybody needs insurance, so they're in a environment like that. And B, these are some of the most well-run business managers and owners or founders. Again, I know this isn't sexy, but what I want to highlight this is you should have exposure to a couple of these. And if and when interest rates start to move lower, if you see this sector fall because lower interest rates is going to mean lower investment income, just like you hear a lot about more of the financials and the banking sector. Lower rates are going to be bad for them. It's going to hurt their margins and profits and all that. Look through a lot of that noise. And if you believe that if these stocks move lower on fears of interest rates moving lower, that's going to be a good entry point. That's the takeaway there.
I think you'll really love Wall Street Unplugged Premium. The Wall Street Club Premium is my members-only podcast where I dive even deeper into this week's events. I'll tell you specifically what moves you can make today. Specific investment ideas I'm recommending and tracking each week. Also, the news we're picking up from our network of insiders. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today and you won't miss a thing. That's WSUoffer.com.